Welcome to the weekly market update. First, I'd like to start the session by giving you some information about me. My name is Ihab Jubail. I was born and raised in Egypt. I have a passion for financial trading as well as teaching. I have been trading for a number of years, mainly on Forex and commodities, and in recent years, I have also set up my own trading robot signals and website. I host online webinars and seminars on investment and financial trading regularly, and I provide my service to subscribers worldwide. Now, let's start the session. Relatively quite weak from the US, but markets remain on guard for any action from China. Here are the events that we will be looking at this week. On Thursday, 14th of January at 12:30 a.m. Australian employment change, and at 12 p.m. UK interest rate. On Friday, 15th at 1:30 p.m. US core retail sales. Risk aversion dominated the global financial markets last week, led by developments in China, the newly implemented circuit breaker in Chinese stock markets were triggered twice during the week on a stock market sell-off before such measure was suspended on Friday. Also, China devaluated the Chinese yuan to almost a 5-year low before changing their mind today. US equities suffered the worst weekly decline since the year 2011. Sentiments stabilized mildly on Friday, but the technical developments suggested that risk aversion would likely stay at least through January. In the currency markets, Japanese yen and Swiss franc were the strongest major currencies, while commodity currencies were all pressured, followed by sterling. Dollar was mixed, and in spite of a strong non-farm payroll report on Friday, the dollar ended the week lower against the euro. In the US, the Federal December minutes revealed some members are increasingly concerned over inflation remaining below 2%. ISM manufacturing contracted for a second consecutive month and at its fastest rate since July 2009. The ISM manufacturer contracted for a second consecutive month for its fastest rate since July 2009. Then services PMI missed expectations to provide further fears of a US slowdown. However, Friday's non-farm payroll data presented less dark data to close the week, printing 292,000 jobs. It was expected at 200,000. Actual release was 290,000 jobs. And unemployment rate remained unchanged and at multi-year lows of 5%. In Europe, The euro continues to show signs of potential strength against the US dollar and is already accelerating higher against the pound, New Zealand dollar, and Australian dollar. So the case for a stronger euro dollar continues to build over the near term. Last week, inflation for Germany and the Eurozone was yet another round of data to miss expectations, painting a dark outlook for 2016. China was a key driver towards last week's turmoil. Manufacturing PMI contracted for a 10th consecutive month, and services PMI appears to be slowing, adding to concerns of a global slowdown. To mix things up, China introduced a new circuit breaker to help calm their stock markets last Monday, where a 5% decline triggers a 15-minute trading halt and a 7% halt trading for the day. Both circuit breakers were triggered within 30 minutes on its first day when they applied it. Investors saw the new measures as a reason to rush for the exit, and after 4 successful days of trading, the system was cancelled on Thursday, which resulted in calmer trading conditions on Friday. Further gloom was presented over the weekend from the producer price index that was also less than expectations. So bad data and more data from China, and it was key driver towards last week's turmoil. In the UK, the market still seem to think it will be a long way off, so any surprises from MPC voting members over the coming months will be as good as a rate rise, so send the pound higher. Manufacturing and industrial production continue to meander around the zero level, so if this trend continues, or sideways range to be more precise, we could see weaker figures down the line for their PMIs. Last week, UK produced some of the better PMI reads, with construction at a healthy rate of expansion of 57.8 and services at 55.5, only a tick below the 55.6 expected. So it was almost as expected, the services PMI. However, this did not stop the pound breaking to a 6-year low as the US dollar benefits from safe haven flows. Pound yen, a 3-year low, and euro pound breaking above the October 2013 bearish trend line. In Australia, the unemployment will gain lots of attention this week as it printed an expected 5.8%, its second consecutive month below the 6% threshold. The print of 71,000 jobs last month was ridiculed on Twitter and media, as this is equivalent to around 4 million jobs being created by the non-farm payroll. When or if converted to the US calculation. Home loans are expected to have cooled off further. Commodity prices declined a further 23%, whilst manufacturing, services, and construction all declined from previous reads, with only manufacturing above the 50 threshold, the threshold for expansion. Global sentiment weighed heavily on the Australian dollar crosses, which saw Australian dollar yen break to its lowest since October 2012. Australian dollar Swiss franc 3 months low, and Euro Australian dollar now at 3 months high. Australian dollar this pair is now back below 70 cents and is closer to break to 7-year low. In Canada did not to miss out on decimal growth data, which saw IV PMI contract, industrial production, and raw material prices also below expectations and contracting. The RBC market rate of manufacturing printed a 5-year low of 47.5. It was expected at 48, worse than expected. Headline employment initially looked promising at plus 22,000, expected at 10,000. Oil prices continue to trade below $34 as a dispute between Iran and Saudi Arabia makes it less likely there will be less supply by the Organization of the Petroleum Exporting Countries, or OPEC, of which both are members, Iran and Saudi Arabia. The emerging market slowdown has hurt energy demand, and producers continue to pump at record levels, taking crude to touch 12-year low. Now, with the events that we should look at this week. The first event was us today, Australia employment change that will be released on January 14th at 12:30 a.m. London time. Australian employment change release will be an important release for the Australian dollar, as recent news out of China has not been providing any support for the currency. All bad news. If we were to get, and you know the relation between China and Australia, if we were to get an even worse figure, Australian dollar could reach some strong support levels. If the opposite is true, then we may see a bit of rebound. Anyway, it's forecasted at minus 11,000 against the previous release at 71,000 last month. And the Australian unemployment rate forecasted at 5.9%, previously 5.8% last month. So our trade plan. The deviation that we are looking for is at least 25,000. 25,000 or 30,000 or more of this deviation. You know, the deviation is the difference between the actual release and the expected number. Expected or forecasted at minus 11,000. So we look for deviation of more than 25,000. So if this difference or this price factor hit, usually it produces about 40 to 50 pips of movement in the direction of the difference. If it's positive, for sure it will be positive for the currency. If it's negative, it will be negative for the currency, for the Australian dollar. And expect to see the effect of this news to last minimum 45 minutes to 2 hours. Typical news effect should last under 2 hours. One other important news to pay attention to is the unemployment rate, which is expected to rise slightly to 5.9%. It was 5.8 last release. If we don't get a conflict with the employment change, then we will proceed with the trading plan. We will look to trade this news using after news retracement method. We will wait for the market to retrace and stay out of the market during the release time. If we get a plus 14,000 of release or more, our bias will be to buy rise option of the Australian dollar against weaker currencies. If we get a minus 36,000 of release, our bias will be to make full option of the Australian dollar against stronger currencies. We will only enter the market and buy our options after we see a decent retracement from the initial spike, and if we get those release numbers, if our deviation number is hit. So we will make rise option after retracement if we get plus 14,000, full options at minus 36,000. But if we don't get the deviation number, I expect the market to follow the pre-release market condition and sentiment and just follow the pre-news trend. Like in the chart, as you can see, the trend is downwards. So if the trend keeps going the same and we don't get our deviation number, I expect the Australian dollar to weaken even more. So it will be a good opportunity to make full options at this time. But just wait for 5 or 10 minutes after the news release to see the sentiment of the market. Second news with us, tradable news for the week, is UK Bank of England interest rates that will be released on January 14th at 12 p.m. UK Bank of England interest rate decision could potentially set the pace for the pound as it's the first MPC meeting of the year, with MPC now releasing sentiments and vote counts. I am sure there will be plenty of market reaction if there is any surprise. It's forecasted at 0.5% as previous release. Actually, last change in the interest rate in the UK was 2009, as you can see in the chart. If Bank of England hikes rate to 0.75%, we will buy rise option of the pound immediately. Because of the level of the surprise, I think you will see a strong trend change for the pound upwards in the next few weeks. Even so, I don't expect it will happen, that Bank of England will hike the rate. But we will wait and see, and after release of the actual release of this news, we will take our decision. On the other hand, if we get a surprise increase to 400 billion or more of the APT or better known as quantitative easing. If we get more than 400 billions, I would would send a bearish signal to the market, and we should make full option of the pound. More quantitative easing, more weakness of the currency. However, further stimulus with this quantitative easing is likely to help the pound in the long run. So, if you missed the original fall entry, if we get 400 billion, I would suggest to make rise option of the pound instead of fall options at support. So, if the rate hikes at or 2.75, we'll make rise option. If we get 400 billions of APT or quantitative easing, we will make full option in short term and rise option in long term or at first support. There is also a possibility for a third scenario that Bank of England will cut rates to 0.25%. And if that is the case, it should be a full option on the pound against other currencies. If we don't get the deviation number, I expect the market to follow the pre-release market condition and sentiment. And if the same trends that we have now in the chart, it will be downwards. So if we don't get any change in the interest rate or at the APT, I expect the market to keep going in the pre-release trend. Last news with us here today is the US core retail sales that will be released on January 15th at 1:30 p.m. London time. US core retail sales is usually a good market mover, and with holiday sales being the main focus for this release, this figure could move the market if we were to get a strong surprise in either direction. Just a note, judging from the last non-farm payroll last Friday release, I believe we will get a better than expected figure. It's forecasted at 0.2%, previous release at 0.4%. How to trade this news? The plan to trade this release is straightforward. We are going to wait for 0.7% release. 0.7% release or better to make rise option on the dollar. Or minus 0.3 or worse to make full option on the dollar. So 0.7 to buy rise option and minus 0.3 for full option on the dollar. If we get an in-between release between minus 0.3 and 0.7, we will need to look at the pre-release market condition and sentiment as usual in order to make a decision or just to stay out of the market. We will trade this news release using after news retracement method. We will pay attention to both headline and the core retail sales figures, but our focus will be on the core figures, core retail sales. And the usual default pairs for this is dollar, yen, or euro, dollar. So after the retracement, we will make rise option if the actual release hit 0.7% or more, or full option at minus 0.3 or worse. If we don't get the deviation number, I expect the market to follow the pre-release market condition and sentiment for the dollar at this moment or before the news release. I want to remind you, if you missed the webinar or want to watch it again, you can watch it at binary.com YouTube channel. You can also find instant updates of the news at resources page at my website ehabjubil.com. Go to ehabjubil.com, press resource page, and you can see instant and automatic updates for the news. So then, I'd like to thank you for attending today's webinar. We will hold the following webinar next Monday. Goodbye and see you next time.